Welcome to Mad Money. Welcome to Cramer. My friends, I'm just trying to make you a little bit of money. My job is not just to entertain you, but to educate, to do some teaching. That's always been the case, hasn't it? So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. This setup's a great one. That's what I see right now. And I want to get a jump on it as Mad Money winds down for our 20th year. The chief pillar, takeovers and acquisitions. They're going to be an extraordinary force for the bulls in 2026. I'm going to try to get the right theme. They won't necessarily move the averages in a visible way. Like today, when we got some real takeover news, but it didn't play an obvious role. Dow gaining 228 points, S&P rising 0.64%, NASDAQ advancing 0.52% as the Christmas rally continues. But I want to really get into this because I'm so worried you're going to leave. I don't want you to leave this market. I know it's high. I know people say it is. But there's things happening. There are mergers and acquisitions that are really special to you. Some don't do that much. I get that, but others do. The kinds you're going to see in 2026. They're strategic, they're valuable, and they're going to make you a lot of money. Before I go into the specific deals, though, let me tell you why these transactions are so important to you and why you must stay in the market to profit from it. First, the stock market is fundamentally about supply and demand. If you increase the number of shares, then the averages may have trouble advancing. Periods of great stock issuance can lead to uncomfortable moments. We've seen this. There may not be enough money coming in to sop up the additional supply. So what happens? The market goes down, a bear market. But takeovers, they can temper the market's endless stock issuance. Now, I think we're actually going to need that because, see, I also expect a very robust issuance year, with a few potential blockbuster deals, one from OpenAI and one from Elon Musk, flooding the zone, so to speak, with new stock. It could be hard to overcome that much new supply. Fortunately, public companies keep buying the private companies that are held by private equity. That's good. We don't need these potential IPOs. Tight supply means higher stock prices. Second, I know that the market did well under the Biden administration, but I believe that most of that advance occurred despite the president. I say that because Biden didn't care much for the stock market. I knew that. And he had the single most dogmatic anti-merger individual running the Federal Trade Commission that I've ever seen. Lina Khan worked hard to twist logic to try to veto almost every deal. Now, in fairness, she genuinely believed all mergers were inherently anti-competitive and punitive to someone in each case. But that attitude removed a key way for you to make money in the market. The administration, this one, much more friendly. So far, we've seen a propensity to believe in deals, recognize their value to the market, the customers, the shareholders. The previous FTC head really didn't factor in the value to you, the shareholder. That's not the case anymore, and I salute that. Third, the markets awarded some of the acquiring companies with a higher stock price. Now, that rarely happens, but now it's happening right now. Somewhat consistent with the incredible market that I see happening. Finally, CEOs are beginning to realize that there can be many gains from artificial intelligence, but the gains come with turmoil and stress. You may be able to fire a huge percentage of people and replace them with AI, but the disruption can cause a company to miss its quarter or maybe many quarters, punishing shareholders. It's better to be privately held. The most salient takeover battle right now is the contest for Warner Brothers Discovery. Here we have a public company that's more like a private company, Paramount Skydance. I say that because its bid is personally funded in part by the fifth wealthiest person in the world, Larry Ellison. His son runs the business. In the fight for Warner Brothers, and Paramount is going against Netflix. Today we get more assurances that Larry's willing to provide backstop financing for the acquisition to the tune of $40 billion. But Netflix wants it, and you know what? I think Netflix has the blessing of Time Warner board. Unless Ellison comes back with a huge amount of money, I don't think they get it. What I care about is that there are two bidders with big pools of capital trying to get this one asset. Netflix isn't known as a deal maker, but they've surfaced out of the woodwork. Ellison personally isn't a deal maker either, though his principal employer, Oracle, has been known to make deals. Larry's standing up for $40.4 billion, a personal guarantee. Let's not lose this forest or burn it down for the sake of the trees moment. This stock, Warner Bros. Discovery, was trading at $7 when I had dinner with CEO David Zaslav just 7 months ago. And he said the company's worth $34 a share. You know what? I think he's going to be right. Everyone keeps talking about how expensive stocks are. Was Warner expensive at $7? Isn't that the real takeaway? It turned out to be dirt cheap. Take that, bears. Or how about the deal this morning where Trian, the fund led by Nelson Peltz, and an outfit called General Catalyst Group are taking the storied money manager Janus Henderson private for $7.4 billion, which is 18% above where it was trading back in October when Trian and its partners made their first offer for the company. The big story here, Janus knows that it wants to move aggressively using AI to come up with great things for investors. The performance for most of their funds has been stellar. And if you have money with them, you won't even notice these moves they're going to be making that I'm about to talk about. But Janus doesn't feel it can make these kinds of moves with AI without crushing its stock as long as it remains a public company, which is why it wants to go private here. I think this deal is the template for dozens of companies going private in 2026. Then there's a whole nother template. Cintas trying to buy UniFirst, an ongoing saga that has the #1 uniform retail company, Cintas, trying to acquire the #3 player in the same business. There was an indication of interest via Cintas in 2022. Then in January of 2025, Cintas formalized a generous bid that was rejected. Now it's back with the same bid, $275, which is a 64% premium to where the stock had been trading. But get this. This is what's important. Cintas is so confident that the regulators will bless this deal, that they're offering a $350 million reverse termination fee, bear with me, on this $5.2 billion transaction. Therein lies what's most interesting. If Cintas had offered a termination fee under the old FTC, there was a good chance they would have had to pay it because Lincom would have eagerly blocked this kind of deal. But this administration wants strong companies that can extend their reach, confident that others will rise up and challenge them. If you're a client of UniFirst, you actually, of course, may worry that your uniform bills are going to go up, and the government's going to look at that. But Cintas, they're not stupid. It will lose clients if it raises prices too much, as there's always someone willing to come in underneath. UniFirst has been adamant about staying independent, but it's a public company, which means it's always for sale at the right price. Frankly, I think a 64% premium seems to me to be the right price. Finally, there's the everybody wins kind of M&A. This morning, Stanley Black & Decker sold its aerospace manufacturing business, Consolidated Aerospace Manufacturing, to Howmet, a crackerjack aerospace company, for $1.8 billion in cash. This is a terrific deal for Stanley Black & Decker shareholders, because that company needs to repair its balance sheet, hence why the stock rallied 3%. Howmet, which we affectionately call How I Met Your Mother, can become an even bigger player in aerospace, which is why that stock jumped $4.68. The bottom line, these are all fantastic templates. Two acquirers with stocks that go higher, a buyer confident that it can merge the #3 with the #1 in the same industry, and a company that can't get AI right without hurting a quarter or two profits. So why be publicly traded at all? And then finally, there's Stanley Black & Decker aerospace business. Turned out to be worth more than anyone expected. New patterns, new methods, new money. What's not to like? Mark in Massachusetts. Mark.
Jim, the Patriots are back, but when is Costco going to be back?
I was at Costco this weekend trying to check it out, trying to figure out what the heck is wrong. I think what's wrong is the stock got too high. I would have thought at 41 times earnings, it's done going down. That was wrong. We did sell half the position. I can't believe I sold any of it for the charitable trust. We had to. I don't like the re-ups, what we call the people going back to the club and getting a new card. And I've got to tell you, a replacement card. I've got to tell you, I don't like it still. I had a great time at Costco yesterday with my wife, but that doesn't necessarily translate into people re-upping at a better rate. I am concerned I might sell the rest. Let's go to Nick yeah, I know that's big. Let's go to Nick in Connecticut, please. Nick.
Hey, Jim, I'm a first-time caller, a long-time listener and club member. Thank you for everything you do. I really appreciate it.
Thank you for calling. Thank you. How can I help?
Absolutely. I bought Home Depot in September expecting some upside from the anticipated Fed rate cuts, but the stock is down after those two cuts recently. Should I buy more, sell, or hold?
Yes, I would buy more. It's a big position for my charitable trust. Why would I buy more? Because we are going to get more rate cuts, particularly because the president wants them, and he's going to pick someone who, forget all this nonsense you hear, they're going to cut rates and cut rates dramatically. And you have to be in Home Depot for that because it's the single best way to play a turnaround in housing. It's the only one housing-related stock that we have in the trust, and I feel very good about it. Right. As we head into 2026, I think takeovers and acquisitions will be the chief force for the bulls. And to that, I say, what's not to like? Oh, my money tonight. we're revisiting our 25 questions for 2025 and seeing how the market stacked up to our expectations this year. First, I'm looking at the macro picture to see how the economic backdrop affected your portfolio. Then I'm going sector by sector, from commodities to consumer packaged goods, and I'm getting a read on the REITs when I sit down with the CEO of Prologis for the last time. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.